Cool, guys. I think let's kick off. There's still a few people joining. Thank you for joining us this morning. It's great to speak to, I guess, most of you for the second time this week. And we'll be speaking to you again next Monday as well. So thank you for your time. We appreciate all the airtime we have with you. We know time is precious. As always, we hope that the session's going to be valuable to you. You're welcome to ask questions as we go along. Either just put your hand up or pop it in the comment section. There will also be time for questions at the end. On the agenda today, we've got three topics we want to quickly run through with you. So Ian is going to focus on equities as a risk asset class, just picking up from our fundamentals of investment session on equities as a long-term risky but inflation-beating asset class. So we will look at the performance of some of the global equity markets, as well as some of the companies in the various seed building blocks. So I think that'll be quite an insightful session. Continuing with unpacking our new shortlist. Well, it's not so new anymore, but continuing on that journey, Tawanda will focus on that low equity section today. You'll remember last month we spoke about the income section. Today we'll do the low equity. And then next month we'll go on to the balance fund section, the multi-asset high equity. So low equity is obviously that bridge section that sort of sit between income funds and balance or equity funds, and a section that's often overlooked, but a section that certainly can play a very key role in building client portfolios. And then closing out our session today, Mike will have a quick look at how the revised seed stable strategy has actually played out in the fund. On that note, Ian, I'm going to hand over to you. Thank you.
Awesome, AD. Thank you, man. And good morning, everyone. Great to be with you guys. So yeah, as Adrian said, a little bit less focused on economic stuff. I've got one slide just on a bit of economic slide, bit of macro. So let's just look and recap how we've kicked off this year. So we had the slide a month back, and I've just updated it for the end of March. So these are all your sort of risk assets around the world in terms of equity markets, and except for the JSE, everything else is in dollar returns. And so we obviously had a cracking start in January. We pulled back across all the risk assets and then up again in March. So it gives you a little bit of a sense of what's happened. You can see there that yeah, I mean, I've put that Bitcoin on there at the bottom just to give it. It's like the classic risk asset. And you can see there. I mean, it's exceptionally volatile, down a massive 64%, as everything went down in 22 as interest rates moved up dramatically. But we've had a big rebound up in January across all the risk assets, including the JSE in January. And it's just interesting how, you can just get a sense in so many ways of how correlated the markets are when you just look at green, red, and then green again. It is just very interesting. Obviously, a lot more muted on the JSE. We'll cover and look at that a little bit. But you can see there, obviously, the gold came up. And then the NASDAQ. I mean, the NASDAQ is all your tech shares mostly. And, you're up 10% in March. So if we go to the next slide, as I said, just really today I don't want to be focusing or spending too much time. We spend so much time looking at sort of the macro and the interest rates and inflation data, but I think this sort of distills it down into maybe one picture, and that's really just your growth forecasts, which come up and get updated from various bodies. And this is the IMF data, and I think the picture generally is pretty muted across the world, except for a couple of key areas. This came from Kevin Ling's slides, and he highlighted the South Africa. It's been downgraded as a forecast, down to pretty much flat for the year, and pretty muted for the next year as well. Growing at 2%, even growing at 2%, we obviously not going. We're not going anywhere. We're actually pretty much standing still for the most part. So we need to be going at a much bigger clip and a much higher clip than that. You can see that China and India. I mean, those are the type of numbers that we need to be looking at. but the rest of the world, especially on the advanced economies, is fairly muted as well. And I suppose that's all understandable. We understand, I think, in general, that the world's in a tougher space globally from a geopolitical perspective and from an interest rate perspective and inflation perspective. But at the end of the day, you can look at all of this and say, okay, well, what now? Where do we put our money? How do we advise clients? And so, as Adrian said, I mean, I think we just got to come back to the basics. And so, if we look through all of that, if we go to the next slide, Lisa, I've put up here now, and this is reverting back to the long-term numbers and percentage returns of some of the key markets. Now, these are all in US dollars, and for all of the rest of the numbers, it's returns in US dollars. And I think if we come back to the sort of premise that an investment into a company as a risk asset is one of the best ways and methodologies for investors to overcome a growth scenario, ultimately to overcome inflation.
Yeah, and I think you've muted yourself.
No, someone muted me.
Oh, sorry.
Okay. An investment into a company has got the best ability. Now, I think the message today is that it can take a little bit of time, and that's the thing that we all have to understand, and we obviously investors really need to try and understand. So I've highlighted here for all of these slides the 1 year number and the 20-year number. Okay, 20 years is a long time, we know that, but I think we've got to try and get the message across to clients that we've got to extend that investment horizon longer and longer in so many ways. So 1 year, it's been traumatic, and this is the 1 year up rolling up until the end of March. So we're still in the red across so many jurisdictions. JSE minus 13% in dollar terms, but pretty much across the board, it's been it's in the red. Europe bounced up pretty strongly, from a very low base, and so that's pushed them into the positive. But I think as you extend out your time horizon, and you go to 5 years, 10 years, and then I've highlighted the 20 years. These are the numbers that you should start seeing. It is interesting to see that the JSE, you've got to go back to 20 years to get a return that's equivalent to the rest of the world, and in fact slightly higher. So 11% there is the return of the JSE in dollar terms. So these are all dollar terms. And it's obviously in that period superseded the S&P 500 at 10%. If I extend out the periods for a lot longer, the S&P has been one of the best, and that's obviously the US markets, the top 500. That 10% has been fairly sticky over long, different periods. I can go 25 years, 30 years, that 10% is there. If we look back over a more recent past, and the recent is a long period, 10 years, 15 years, the JSE is a lot more muted. And we'll touch a little bit in on that as well when we look at some of the detail. So drilling down in from that, we go to the next slide, Lisa. What I've done is pulled out, and we've got four slides here of the fund managers on the global side, and then the companies on the local front. And so again, I've kept the period the same. And these are the top holdings for our one fund manager, Lindsell Train. And again, the 1 year number in dollars, 20-year number, but compounded up over 10 years and 5 years and 3 years. And as you guys know, and I think as the message that we've been trying to telegraph over a long period of time is that there's a lot of good quality names and business and companies globally. The managers that we look at generally, but not predominantly, are looking at these sort of quality names, the type of businesses with high cash flow, typically more consumer orientated, typically brand type names. And so you can see there the likes of consumer staple companies like Unilever, that they've invested in. Diageo, consumer business. But then other tech names, and those might not always be that obvious. With the case of a company like the London Stock Exchange, which you can look at that type of return over 20 years, that's given you a 17% compounded return. Over 10 years, 20%. I mean, it's just been a phenomenal business. And these businesses have great high moats around them, very difficult to get in. They're actually a lot more technology type businesses now. You know, with the likes of London Stock Exchange linking up with Microsoft, looking at data analytics, looking at data. So there's a lot more emphasis on data. So you look at a company like that, not easy to come in and sort of take them out from a competitor perspective. So these are the type of businesses that you can find globally, and the managers that we've invested into with the likes of a Lindsell Train. Look out for these sort of quality names, and they are, as we've sort of relayed, you know, typically long-term holders. They're not trading in and out of these names. You buy the company as an investor, we get the benefit of the returns annually that they're producing. Exceptionally high returns on equity and exceptionally high margins. I mean, the London Stock Exchange, as an example, is giving close to 50% gross margins. So these are businesses which are really generating high margins and high free cash flow. You've got maybe more contentious names like WWE there. That's a big W, which has been a phenomenal business, generating 27% compounded return over 10 years, 14% over 20 years. But it's come from an exceptionally low base and built up a huge, big monster following to the point where it's going to be merging to be a $20 billion company now, with UFC and WWE linking up. So those are some of the names that come through on Lindsell Train. If we go to the next one, as you guys know, we've invested for some years now as well in Fundsmith. Very similar outlook, but not a lot of overlap. You'll see, I think the one overlap in the top 10 is that Pepsi. So Pepsi is obviously a phenomenal business, with a huge and long pedigree. Not shooting the lights out over 20 years, 9%. It hasn't shot the lights out, but it's exceptionally stable business. You look at other businesses like Microsoft, which they both invested into, and there you're generating, and that company's generating again 27% compounded return in dollars over 10 years, 14% over the 20 years. And then what they both look at, both fund managers look at, is brand type businesses, and the big granddaddy in that space, in terms of high-end consumer goods, is the LVMH, Louis Vuitton, Moët Hennessy, and that business has just built up to be an absolute phenomenal business, over 400 billion, with an exceptionally long pedigree of brands going back hundreds of years with those names, and to the point where the sort of founder, or the current chairman, Bernard Arnault, is who put the two, was instructive in terms of putting the two businesses together, LV and MH. It's obviously catapulted him because of his exceptionally high stake in that business to the richest man in the world. But incredibly well run business, and it came out with some results again the other day, and it just keeps the quarter results ahead of what the market was expecting. And you can look at it now, over 1 year, it's up 30%, and this is obviously to the end of March, and it's been an incredible business. So again, a manager like Fundsmith can buy these businesses. Many times these businesses, through thick and thin, high interest rates, low interest rates, a challenging macro environment, they will do their thing and continue to look for ways to optimize. And because they're generating high cash flow, they can actually, they can keep reinvesting. And no matter what the circumstances or the macro picture throws at them, keep generating returns for clients. For sure, over a 1 year period, you've had some drawdowns, and that's always difficult. No one wants to look at their statement and we down. We invested a year ago, we invested 18 months ago. and when we're going nowhere but down. But these companies are not going to disappear off and they're going to continue to generate the type of returns. Visa is another one, and we've discussed that one. It doesn't have a 20-year record. It only got listed after that, but 20% compounded returns over the last 10 years. If we go to the next one, it's Scottish Mortgage, a little bit more challenging in some ways, a lot more growth-oriented businesses. And you can see they've had an exceptionally more difficult time over the 12-month period, especially with some of the names, the Amazons of the world, the Tesla, which is a high growth, exceptionally high growth type business with big drawdowns. But again, investing into companies like ASML, which you may or may not know. I mean, it's the business that creates the machines that create the microchips. So it's a Dutch business, and it's one of the main, if not, it is the main player. There's not too many competitors in that space at all, and the technology that they've got is just is off the charts, and exceptionally difficult for anyone to come and usurp them. So hence, sitting in the pound seat and generating those type of returns, it's just incredible. 24% compounded return over 20 years. And on each of these slides, I've put the MSCI all country just again as a reference. So, challenging 12 months, but 9%. So I think most investors would be very, very satisfied with a 9% compounded return in dollar terms over the last 20 years, that's for sure. But in a way, if you can obviously get more out of that, and you almost need to be really invested into these really quality businesses to get the 9 or a little bit more than that. So that's all available globally. And again, I think these businesses are not going to fall over just because there's a little bit of geopolitics in the world, and the Fed is going to has raised interest rates. It's still going to raise interest rates, and the consumer's under pressure. So they're going to be around. If we go to the next slide, I've put up here, same picture. And here what we've taken is the top 10 out of the balanced fund. And this is mostly Fairtree with a little bit of Visio. These are the 2 equity managers that we've got. And again, we've put these names, these returns in compounded format in US dollar. So trying to compare like for like in a way with all those previous slides. And the picture here is that if we look at the South African context, in the current top 10, and that's not to say that there may be others, in the current top 10, there are 2 exceptions. That's Naspers and Richmond, which have produced a return in excess of the MSCI ACWI 9%. Naspers has been a phenomenal business, as we know, with its acquisition of Tencent right at the get-go. And so that has all really comes, the 26% return compounded has been one of the best in the world. And that's all come from the Tencent business that they invested right at the outset. Got that 26%. Clearly, it's been a lot more muted over the 5 years, as and that's dragged down even the 10-year number, but still 15%, very, 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 very decent. And then the other exception is Richmond. Richmond is really not. It's not a South African business. It's not at all. It's a global business. It's mostly Cartier and high-end luxury goods. And so you can compare that 14% actually with the LVMH. Those two compete on a global front. And that's a business that's a quality name business. It's a business where, again, super high margins, strong cash flow, super strong balance sheet, run well, strong names with the likes of a Cartier and a few other businesses producing a 14% return. If we look at all the other names, what is very interesting is that over the long term, you haven't compounded up as an investor. And really, we've got a fantastic fund manager there with Fairtree, especially in that you've got to actually trade these names. An example like a Sasol, Anglo American, Impala. These are commodity businesses, and a commodity business over a long period of time doesn't. It can't be a buy and hold situation. You've got to actually trade it. You can see there over 3 years, it's been a fantastic space. 40% Sasol come from obviously an exceptionally low point. All of these over from a 3 years back has come from an exceptionally low point. But you can't say, well, I can just buy an Anglo American and hold it and just be a long term holder, because you're gonna not get the return that you need. And so when you've got commodity businesses, you need to trade them, buy and sell at the right time. Not an easy thing to do. So very different to a more consumer orientated business, growth, quality names, which we don't have a lot of on the JSE. The two there in the current top 10. And maybe it's debatable whether Naspers is, clearly they slowly but surely unwinding out of Tencent. So that just gives a little bit of a picture and of the comparison of the two sort of local versus global, but we try to keep it there, comparing like for like in terms of from a dollar to dollar return. So I think in summary, macro is important. We keep looking at macro. The biggest issue with macro, ultimately for investors, is the inflation. I mean, the inflation has been the big issue. It will always be the big issue from an investor perspective, and it's the biggest headwind for investors. That's what they need to overcome, is the inflation story. There's not many assets, but an investment into a company is one of the ways for investors to overcome that inflation problem and that inflation hurdle. And then and that's mostly because companies have an ability, and I put there in brackets, not all of them, that the ability to grow earnings ahead of inflation. So commodity businesses, when they making money, they make incredible money, and then the tide turns. And so that's why when you look over the long period of time, you can't be buyers and holders of those. So really, there's there's different ways we can slice and dice, and we looked at that in the fundamentals course that we looked at. But broadly speaking, it's quite nice to be able to classify companies as cyclical or non-cyclical. And cyclical businesses are obviously very much linked to the business cycle. And South Africa has a lot of those, and that's really your commodity businesses for the most part. And those require a trading approach. You need to be able to buy and sell. You cannot just hold them. Non-cyclical businesses, if you look at the earnings profile of these companies, like a Pepsi or a Visa or an LVMH, they just year in and year out. Yes, they can go through some years when the earnings top out a little bit, come off a bit. But if you look at the earnings trajectory, it's pretty much steadily up, and the share prices follow ultimately. And so for the non-cyclical businesses, generally speaking, it does require a more long-term approach, and you can hold a company. You don't need to be trading in and out. So broadly speaking, that's sort of the way we've positioned the fund in so many ways. You can't be a long-term just buy and hold companies here on the local market and think that it's going to be fine. Globally, you can. And I think over time, investors will benefit from that type of approach. So those are just a few slides, guys. And we can chat if there's any questions about that. But thanks. Back over to you, AD.
Thank you, Ian. Just two things that strike me from your chat, Ian, is number one, and particularly in a South African context for us as advisors with clients with share portfolios, is that stockbroker, particularly on the cyclical shares, doing that regular trades for us, like a Fairtree fund manager would do within the fund. Also bearing in mind that in a stockbroking account, there's potential CGT implications every time they trade. And then the second one is for us as advisors, when we do look at funds, and we spoke about it on Monday as well. Um, like, for example, the 91 commodity fund. Invest in those funds with a lot of caution, because you're putting the onus on yourself then as the advisor to be that trader for the client, to go into that type of fund at the right time and exit it at the right time.
Yes.
And unless you're doing the same level of research as a Fairtree would do, or as a stockbroker would do, you potentially gonna find yourself in the hot water with that type of approach. So our recommendation would be to look at fund managers that can trade between asset classes, or within an asset class has the ability to move between sectors.
No, that's right. Good points, sir. Very good points.
If there's no question at the end for this point, T-Man, we're going to hand over to you to take us through that low equity section on the shortlist.
Thanks, Adrian, and good morning, everyone. Great to speak to you again. So we're going to go through the low equity section, and we'll just kick off with that investment strategy chart. And just to position where we are, what we're looking at. So if you look in the low equity, then we're looking at a client that at a moderately conservative client that is looking for both income and growth. I think what we discussed previously was a conservative client that's looking purely for income. So we discussed those income strategies, but also now to incorporate some of the growth that Ian has been speaking about within those equities. You want to incorporate that for a client, a moderately conservative client, just include a little bit of growth so that you can get a little bit of extra return. So these portfolios would target between CPI plus 2 to 4%, and we're looking at an investment horizon of a minimum 3 years, or 3 to 5 years. I think what we've seen in recent years is income funds have done relatively better than these low equity funds. So a lot of clients and advisors have preferably used as an investment strategy, combining income funds and high equity funds, growing income from those income funds. Using the low equity funds is a different way of essentially doing it without having to worry about that asset allocation decision. So you do have a component with these funds allocating up to a maximum of 40% to equities. You've got the fund managers making that asset allocation decision between the income assets and a little bit of growth assets, being that equity that they can include within these portfolios. So if we just kick off, if we look again at how we read that shortlist, I mean, it's still, we've had this for a few months, but it's still a relatively new document. But just to go through that again, just how to read that shortlist matrix and focusing on that moderately conservative category that we're looking at. We read this shortlist just from top to bottom, and as we indicate there, just that top section just indicates the funds that are listed within that category, so that moderately conservative category. Then you can see that in that top section, we've got a list of the funds that we say are the recommended funds. In the bottom section, then that just gives you some examples of blending strategies. Funds do go through different cycles of performances, so we do recommend blending funds with different characteristics. And then within this section, I'll go through some of those blends as well. If we move on to the next slide now, to just go through the individual funds that we've actually got on the shortlist in this low equity category. Before I go into these funds, I probably just want to highlight two funds that are not on this list. One fund being the Portfolio Matrix Dynamic Income Fund, which we discussed in the last section. It's an income fund, but quite an aggressive income fund, which we think, because of its relatively higher volatility, can be grouped with these multi-asset low equity funds, in as much as it doesn't have any equity within that fund. The second fund that I would also like to highlight is the MNG Inflation Plus Fund, which I don't have on this list, but is actually a multi-asset low equity fund. This fund is quite aggressively managed, or has a loftier return target, CPI plus 5%. So it tends to be more aggressive and more volatile than your normal low equity funds. And we tend to group that fund, or recommend we think it's a good fund. We tend to recommend that to group that fund with a medium equity type of funds. If we just focus now on the funds that we've grouped in that low equity section, then you see that we've tried to mix fund with different characteristics, and you've got boutique managers, large managers, and obviously the seed there as your multi-manager, diversifying across different strategies. So a mix of different funds, different managers with different styles to try and capture those different characteristics so that we give you different funds that can blend well together. Just looking at that boutique section, then we've got the Apex Absolute Prescient Fund, and we've also got a new fund that probably a lot of you are not very familiar with. It's the Amplify Wealth Protector Fund. And I'd just like to highlight that Amplify actually outsources the management of that fund to Truffle Asset Management. That's a boutique that maybe more of you might be familiar with. Quite a good manager that we like out there, that has come from a hedge fund mindset. We've also got your normal large managers there. So we've got the Alan Gray Stable Fund, your Coronation Balanced Defensive, and two Net Group funds there. Also, as you would be aware, Net Group outsources the management of those funds. So on the local side, then we've got the Net Group Investment Core Guided Fund, which is managed by Taquanta Asset Management. And then we've also got the Net Group Investment Stable Fund that is outsourced to Ford Asset Management. And as we said, the Seed Stable Fund is the multi-managed fund, diversifying across different strategies, across geographies, just to give you a diversified portfolio. If we look on the next slide, then we are looking there again at the funds, just with the to point out the different characteristics and the different investment philosophies that these funds have that result in different portfolios that they build. So you can see that we've got funds that have sufficiently long history, large funds as well on a relative basis, and then, like I said, different philosophies and processes that they follow there too, which helps in the sense that when you try and build this shortlist, then we're trying to give you different funds that have different return or performance cycles. If I just if I just focus a little bit on that philosophy and process, you can see the ABACs. I think what we can say about a lot of South African managers is they all have some sort of valuation bias to their processes, but then there are different elements which I've put in both that they look at there that kind of differentiate the way that they do things. So Apex really great at that active asset allocation, and Amplify similarly active asset allocation using derivatives within their portfolios, using quite a large tool set to build their portfolios. And Amplify, which is that Truffle Asset Management, like I said, uses a relative valuation. So looking at the different asset classes and using relative valuation and looking at which of those asset classes are most attractive at any point in time, and actively moving across those different asset classes. And as you can see within those large fund managers, then Alan Gray, quite differentiated in the way that they look at they're a lot more contrarian to what the market is looking at. So a contrarian value approach, Coronation valuation driven. The Net Group Investment Core Guided, like I've said, follows just pretty much tracks passive strategies. So it's a local strategy that is tracking passive strategies to build an asset allocation portfolio. And then the Ford Asset Management, managing that Net Group Investment Stable, use a top-down macro approach and combine that with a bottom-up approach. And then this actually gives you quite a different portfolio. And I think as an example, I can give you the kind of offshore exposures that these funds have. And if you look at how differentiated they are, then Amplify with their relative valuation approach have less than 20% in allocated to the offshore, and then the Net Group Stable Fund has 44% allocated just by virtue of that top-down and bottom-up approach. So you end up with vastly different portfolios just by virtue of those the different investment styles that the managers look at. If we just look at the performance, for these low equity funds, then a 3-year period is a decent is the minimum kind of holding investment period for such a fund. So if we look for at the last 3 years, the returns, this is the risk reward chart. So you've got on your vertical axis your returns, and then on your horizontal axis your volatility as shown by that loss deviation. And what you're just trying to do there is to deliver good risk adjusted returns, so better than the average return, which is represented by that multi-asset low equity average, and then also trying to minimize on your volatility, which would be on the top left quadrant. So you can see the seed stable fund and the Allan Gray stable fund have probably got the best risk-adjusted returns over the last 3 years, with much better than average returns and much lower volatility. The ABEX Absolute Fund has also done better than average with a much lower volatility. Some of the other funds, including the Ned Group and your Coronation, have delivered better than average returns, but obviously over that period, slightly higher volatility, which is something that can okay, obviously, with the vastly different investment style. If we look at the performance over a longer period of time, just on a rolling basis, just to see how these 3-year returns have been changing over time, and just so that I make sure that you don't have just one crowded chart, I'll go through those different categories that we looked at, the boutiques and then the large managers. So just to kick off on that, just on the boutiques section, then you can see the ABAX and the Amplify just on a rolling 3-year basis, with those gray blocks actually representing your peer group quartiles. Then these funds have pretty much delivered top quartile rolling 3-year returns. So quite a great performance over time for both funds. Obviously, the Amplify Wealth Protector has a shorter history, but over that Trafo has a long-term history, but this fund, and specifically this fund, only started in 2016, but has delivered exceptional returns, better than average returns, since its inception. If we look at the large managers, just on that rolling 3-year performances as well, then you can see that it does alternate over time. At times, you've got top quartile performances, and then at times you've got bottom quartile performance. Obviously, this chart looks a little bit crowded because you've got a few more managers there, but they all do deliver decent performances over the long term. But you can see that at times it's cyclical. It's top quartile, and then at times not top quartile performance. So if I just zoom into one of the funds, the Allan Gray Stable Fund, you can see that this fund, like we discussed earlier, it's had an exceptional 3-year performance. Last year, it's currently probably one of the top performers within this category. But if you also look at the long-term history, you can see the cycles that it goes through. In that beginning period, there you can see that it was in the bottom quartile, performing less than the average peer. But then post that period, delivered exceptional performance, better than average top quartile performance, and then also went through another difficult period where it delivered less than average performance, and then yet again it's gone through the most recent period where it delivers top quartile performance. So you can see that this performance can be cyclical, but it's really a matter of understanding these funds, that they actually can go through cycles, and blending such funds together is what we recommend, obviously because of the cycles that they go through, which is why on the short list, which as we move on to the next section, then we've got the blends that we recommend for you. We've given you funds that have different characteristics, and then blending these funds together, putting them in different components, just helps to minimize the volatility over the time. If you can also diversify across investment styles, and then you can also minimize the cost just based on the different cost strategies of the funds. So on the shortlist, we've given you 3 different blends that you can that you can look at. But what the additional thing that you can see in the blending options is that in certain instances we can include funds from different categories. As an example, in that more defensive category, we've got the Portfolio Metrics Dynamic Income Fund, which is an income fund, slightly lower volatility than your low equity funds, but much higher volatility than your income funds. That would blend well in a defensive option of those low equity funds. And then we've also got a strategy that is minimizing the cost. So all of these strategies, we still do try and optimize for the return. So all of these different funds delivering a better than, we want them to deliver a better than average return than your average low equity fund, but also a more consistent performance over time, just bearing in mind that some of these funds can go through performance cycles where they either outperform or underperform the average of the market. So if we just look at the performances of these blends, just over the since a common inception, since 2016, the inception of that Amplify fund, then you can see that the 3 different blends that we've given you there do deliver or have delivered historically better than average returns, with the defensive one having the least volatility, because that's what you're trying to do there, minimize the volatility. But then the low cost one has also delivered exceptional returns with less volatility than your average of the peers. If we look at it over the last 3 years on my next chart, then you can also see that all over the last 3 years, all of the 3 blends have delivered better than average returns and also at lower volatility than your average fund. So this is what we're trying to build portfolios that deliver more consistent performances over time. And if we just look at my last chart, which is just your trailing returns over time, just on a year to date and up to 10 or up to 10 years, then you can see that these blending options are trying to deliver a consistent top quartile performance where possible. If you look at a very short period on a year to date, then they haven't necessarily given that top quartile performance, but over time, especially if you look at that 3-year performance, which is kind of like the minimum period that you would want to look at for your portfolio like this, then top quartile performances that you get from the blends. I think that's it from my side. I don't know if we're going to go into questions right now or if we go to the end, but I'm going to hand over to you, Adrian.
Thank you, T-Man. If there are any questions for T, welcome to ask him now. Otherwise, we'll hand over to Mike to just pick up with specifically the seed stable fund and how that new strategy of ours, well, it's not so new anymore, but how that's played out in the fund over the last investment cycle. Thanks, Mike.
Sorry, nearly forgot to turn myself on there. Good to see you guys. And yeah, so obviously Tawanda's, I guess, teed me up speaking a bit about the multi-asset low equity funds in general and on the short list. And then obviously within the seed fund, we wanted to give you a bit more in-depth view in terms of how the stable fund is managed, the seed stable fund. So yeah, as Tawanda said, sort of performance over the shorter period, up to 3 years, has been really good. Longer term, seed stable fund has performed also largely in line with its peers. But essentially, since the end of COVID, we've delivered around 2% alpha per annum over the rolling 3-year periods. Over the last 12 months, it's been around 3% ahead of its peers. It's great to see that a sort of nice 3-year return, because it was around 3 years ago that we really took a look at the fund and how it was managed and made a decision to simplify and streamline the process to try and produce more consistent results. And I think it's starting to bear fruit. As Tawanda said, investors looking to invest into this fund or funds in this category should have a 2 to 4 year time horizon. So this guy's got a longer time horizon than the income fund, but shorter than the balanced fund. We aim to protect capital over 12-month periods, and this has been achieved over more than 90% of the time. And over the longer, sort of medium to long term, deliver inflation plus 4. In the early parts of the of this fund's history, that was a bit more tricky given the sort of tough market conditions, but over the more recent period, we have seen it more sort of regularly hitting this inflation plus 4. And I think maybe just before we move on to the next slide, I mean, we often talk about barbell approach. Arjan and Migs will have spoken to you guys about mixing maybe high and high or growth strategies with more income strategies. But essentially what the stable fund and positioning, again, it's a barbell strategy within one fund. And if we go on to the next slide, I'll sort of show why we talk about that. And essentially, the fund has a portion allocated to growth type strategies and the rest into income strategies. We do this within one fund, which means that advisors, advisors don't need to manage the rebalancing process. We take care of this. We'll shift the weightings between the income and growth buckets as the market conditions change. And at the moment, we're around 50-50 blend, with the income bucket yielding close to 12%, which is quite an attractive yield. Digging more deeply into the income component. So, I mean, these are strategies that should generate returns materially in excess of inflation. Over time, we'll hopefully deliver returns in line with the fund's inflation plus 4 target. It is more aggressive than your typical multi-asset income fund, so like a seed income type strategy. But investors are rewarded with a high expected yield. And as you noted, this component is currently yielding close to 12%, which at current inflation rates is around inflation plus 5%. As you can see, the two major building blocks in the income component are the two bond portfolios. The seed bond component invests into a portfolio of bonds that we can hold to maturity and generate regular high levels of income. The Coronation Bond Fund is a more aggressive or more actively, managed bond portfolio. And together, these two account for around 2/3 of the income bucket. And the remaining third is spread between a few portfolios. They each generate high yields and diversify the assets across a range of strategies. So the clean energy and infrastructure debt strategies gain access to long-term capital-intensive infrastructure projects. As a result of the long-term nature of these projects, investors are generally rewarded with high yields on their investment. The unlisted and direct credit allocate capital to well-capitalized businesses that are looking to grow. Their liquidity premium on this component more than offsets the risk taken. And again, position sizing is important here, so you can see it's around or just under 5% of the overall fund value. And then finally, we have a sort of small sweetener, which is an allocation to structured notes. So these notes reference global assets, but their returns are linked to the rand. So obviously, in the stable fund, where volatility is a more important component, where we do want to maybe gain access to more geographies, we don't necessarily want to take on more currency risk. So this component allows us to access global markets, but delivers a nice rand yield. Given that these notes all have strong capital covenants or protections in them, we expect to generate high teen yields out of this, and therefore put these notes with the income bucket. And then on the growth side, essentially this would mimic your typical balance fund in a more unconstrained environment. Over time, this bucket should do the heavy lifting with generating sort of the real returns for the fund. But obviously it does come with being more volatile. But obviously in conjunction with the income bucket, investors will or should generate decent inflation beating returns with not too much capital at risk. So at the moment, around 55% of this bucket is invested into equities on a see-through basis, just under 45% to global assets, and nearly a quarter is invested into alternative asset classes, so commodities and structured notes on a see-through basis. When looking at the building blocks within this, just under 40% is invested directly into global assets. These should generate sort of mid to high single-digit hard currency returns over time. The building blocks within this component is the C Global Fund, US long treasuries, and US dollar auto calls. So again, the global fund aims to deliver US cash +3, and with cash sitting around 4 or 5%, we're getting to high single digits dollar returns. US treasuries are sitting in excess of 4% at the long end, and they provide some ballast if the markets, if there's market turmoil. They typically generate some capital gains. And then the auto call again, so in there we're sort of looking to yield just under 10% in dollar terms. So a well-structured, diverse portfolio looking to deliver nice hard currency returns. Then on the local equity side, this is split equally between Fairtree, who Ian mentioned, delivered super long-term performance, and the other component is Satrix passive tracker to help manage the costs of the fund. The multi-asset building block is managed by ABAX. Obviously, ABAX, one of the funds, is on this the low equity category, low equity shortlist. They aim to generate asymmetric returns, where they protect capital on the downside and participate in much upside as possible. It's been a star component of the seed stable fund over the last 7+ years that we've held it. And then finally, we do have an allocation to gold. It's an ideal real asset that's shown to protect and grow capital in real terms over centuries, and does also provide a ballast in times of market stress. And then finally, just to look at the seed stable fund, we take the income bucket, we take the growth bucket, put them together on a see-through basis. You can see the asset allocation. As mentioned, it's a very diverse fund. We have just under 30% allocation to equity owned property if you're looking on both local and global side. Global assets sitting again also between 25 and 30%. Quite a large allocation at the moment to bonds, which is yielding sort of close to 11% just on those bonds. So providing a nice ballast for the portfolio, and that bond allocation should over time deliver at least inflation +4, which is the fund's target, and also bonds will sort of 90% or 95% of the time deliver positive returns over any 12-month period. So at the moment, given the high yields on the bond, it is a key component for the stable fund. And yeah, that's it from my side.
Thanks so much, Mike. Guys, any questions? Just a reminder that the next session is on the 17th of May, but we will see you before that, and that's next Monday for the last of the 5 fundamental workshops. So please remember that one at 10 o'clock on Monday, and then the next monthly session is on the 17th of May. Any questions for any of the speakers? We're all good. Well, guys, thanks for attending. It's been great to see you all, and good luck for the rest of the week.